We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
And I'm David Ingles here in an extremely rainy Hong Kong Tuesday morning, 29 minutes to the open. As you can see, stocks, as you can see as well, 0.5% to the upside, extending this global rally as traders boosting their bets for a Fed rate cut in September. Markets now see 3 cuts over the next 4 meetings. Now, President Trump warns India of substantially higher tariffs as Delhi stands firm on oil purchases from Russia despite Washington's protests. And Tesla's China shipments slumping again as it struggles to keep up with the likes of local rivals, BYD and Xiaomi. Welcome to the show and good morning. Lots to get through over the next 2 hours or so. We'll start things off with this market rally, and we're coming off the best day for global equities on Monday. MSCI All Country Index had its best day in about 6 or 7 weeks on Monday. We are continuing to see that. S&P futures are also catching a bit early this Tuesday morning, 0.5% to the upside. Samsung is gaining quite a bit in Korea, and I would imagine some of the tech plays as well in Taiwan, as you can see on your screens. In terms of data, it's, I would say, medium as far as how heavy things are on the data deck today. So we were coming off, Korea inflation came out, you have BOJ minutes, a series of PMI numbers in the last 30 minutes, Hong Kong PMI hitting the high since January, and we should be getting the S&P Global gauge of services PMI for mainland China in about 43 minutes from now. Also coming out right now, that should be coming up on the bottom of your screens, is Philippine CPI, and the dollar peso, in fact, had its biggest one-day drop in about 3 years. We'll get to that in a moment. There we go. Okay, that is, I believe, for the first time in, don't blame the messenger, I'm just racking my brain here, 0.9%, I believe, is the first time we've had a sub 1% read on Philippine inflation going back to, I think, 2020. So as you can see, much lower than expectations. I'll get the statistic correct. I'll correct myself if that's slightly off target. Very quickly, 2s and 10s. So we talked about this, right? So September is now fully priced as far as the Fed cut goes. It's now about 76 basis points that's priced all the way through to the January meeting, which is effectively 325 cuts over the next 4 meetings, is what's currently priced. That's a moving target, of course. Nifty futures and Brent on the Russia, India, U.S. story, undisturbed by the news flow so far. Very quickly, FX markets, euro, it's pushing back against, I think it's a 50-day moving average. It's very much in focus there. That's number one. Number two is dollar yen toward the downside, outperforming most of its peers. The peso's on your screens as well, as you can see, still on the stronger side of the cutoff. And overnight in China, Trip.com reports today. Tencent Music, Baidu, some stocks to watch given the big moves we had overnight. Golden Dragon Index better by 1.4%. And going into the open today, we are likely to extend the rally we're seeing. Futures coming up on your screens. And I forgot to mention this as well. Dollar Hong Kong coming off the weak end of the bad following another intervention coming out of the HKMA to defend the peg. Yeah, Avril, lots to talk about today.
Yeah, and I think one of the key themes we are tracking, the impact from these tariffs as these deal negotiations still under the way, and we have the likes of Trump, right? He is threatening, warning to substantially raise the tariff rate for India. This is something that New Delhi has come out to say is not justified, not reasonable. But if he's taking issue with India over its imports of Russian oil, where does this leave China? And as we continue assessing the tariff impact, what is that going to mean for the Fed rate cut bets?
Yeah, where we're not really seeing, I think, that a point that Mary Daly made in that interview, I believe, with Reuters was it's probably we're getting to a point where it's time to cut. I think we had 2 dissenters, of course, in the last meeting, and the fact that the jobs market data and revisions on Friday, right, is starting to show a softening. That's number one. And point number two is we're not really seeing yet is that going to come. Inflation through the pipeline because of tariffs, not really just yet. So all things equal, It looks like we are headed towards interest rate cuts. Is it an insurance cut? That's certainly one way that some people have framed the likely cut that we're probably going to get in September. Mary Daly, of course, underscoring, of course, that they can't wait forever. More than 2 cuts is the headline, according to that interview there with Reuters. And yeah, here we go. This is the pricing as of about an hour or so back. Nothing much has changed. 76 basis points easing priced, Avril, by the end of January, early next year. So yeah, suffice to say, it's looking like we are entering finally that window for easing to resume out of the Federal Reserve. Avril.
Yeah, markets have gone ahead to price in easing, even though we still have these uncertainties of the way tariffs will play out. And of course, as we've just been mentioning, the president says he'll raise these tariffs on Indian exports over the country's purchases of Russian oil. Let's bring in our Bloomberg News Desk editor, Jill Deeses. So, Jill, talk us through the state of play now between the U.S. and India on these tariffs.
Good morning, Avril. Yeah, so, obviously we saw the 25% tariff rate slapped on India last week, supposed to go into effect later this week. Really quite a reversal from just earlier this year when, India was one of the first out of the gate to try to negotiate something with the U.S. We saw, Modi and Trump meet. Obviously a much different situation now, and it really does kind of seem to be in large part driven by Trump's desire to really kind of drive an end to Russia's war in Ukraine. I mean, we know that Trump is incredibly unhappy with Putin's inability or unwillingness to come to the table with him on this. And so one thing that Trump has been floating for several weeks now is this idea of secondary sanctions on those nations that do buy Russian oil. One of those, as you mentioned earlier, Avril, being China, although at this point the United States-China relationship around trade does seem to be quite delicate, and they do seem to be trying to progress toward a Trump-Xi meeting maybe later this year. We know that China is kind of on a different track when it comes to how exactly its tariff relationship with the United States is working. So that leaves India, which at this point, India has been a pretty substantial buyer of Russian oil since 2022 when that war broke out. India is calling sort of this targeting right now unfair. I think the question here, though, is how much they're able to actually negotiate something. I mean, we know that several weeks ago, Trump was floating, or his administration rather was floating the idea of secondary sanctions or tariffs on nations that do buy Russian oil as high as 100% or so. I mean, that's quite significant. I'm not sure how much of that really factors into how exactly these tariffs may evolve, but it does obviously leave India in a very, very, very tricky situation as it tries to negotiate lower tariff rates with the U.S.
Well, speaking of another front where negotiations are still likely going to take place are the Swiss, and I think what they're saying is they're likely, or they're prepared to make a better offer to the Americans. What do we know about that, Jill?
Yes, that's right, David. So, Switzerland, they were slapped with a rate of 39%. So, I mean, incredibly high among industrialized nations. I will point out, I think, when you look at the deficit, there's a lot in terms of gold exports, I think, are a pretty significant contributor there, as well as pharmaceutical goods, watches, obviously, at Switzerland. But yeah, I think that, Switzerland kind of, took a look at that rate and said, we can definitely do better. And I think that what that really shows about the way that a lot of these tariff negotiations work is that it does seem to be, or at least a lot of these countries feel that it's a bit fungible in terms of how you ultimately work with Trump, that, just because something is slapped on you, that doesn't necessarily mean that is, hard and fast rule here. I mean, we do know that these tariff rates, these new tariff rates are supposed to go into effect, toward the end of this week. But it does seem like, at least from what we're seeing out of India, what we're seeing out of Switzerland is that there is a lot of desire to sort of continue to bring those rates down. And I know I make this point every time, David, but I do think that it's also worth noting that, traditionally trade relationships and, trade agreements take years to develop and really kind of bring together. This isn't something that you can typically do within a few months. And so I can imagine that, you can see a lot of these relationships continuing to evolve over the course of, the next few months, if not the entirety of this Trump administration.
Jill, thank you. Yeah, that's a good reminder. Jill Deeses there, our news desk editor, and to the point Jill was making, right? So it takes a while to make a trade deal, to strike a trade deal, and it doesn't mean once a trade deal is struck, tariffs go away, right? That's really one view from our next guest, Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute, here with us in our studio. Brave the weather for us. Thank you for coming in, of course. I know how it is outside. Let's start with that. The incrementally be getting more trade deals coming through.
Sure.
are we out in the clear as far as tariffs go? Like in terms of the disruption to markets specifically?
So I think the market has been very optimistic, and they have reasons to cheer because tariffs are coming down. Trump made a big move on April 2nd and has been scaling back the rate of tariff ever since. We have seen the pace of deal making accelerating over the last couple of weeks as well. So I think there are reasons to be optimistic insofar as the trade tensions are concerned. But I don't think structurally we are out of the woods. I think striking trade deals doesn't really mean the end of tariffs. Our view is that the Commerce Department is going to continue to pursue actions in individual industries by imposing sectoral tariffs. And Trump is going to use tariff as an all-purpose policy to extract economic and non-economic concessions, which is talk about that is punishing India for buying Russian oil. I also don't think that striking trade deals means the end of the economic shock. We are starting to see those economic shocks manifesting in U.S. economic data, with retail prices being pushed higher, and there's been slowing of domestic demand because of direct and indirect impact of tariffs. And I'm afraid that this stagflationary impulse, because of this negative supply shock, is going to continue to manifest and creating a pretty particular sort of a tricky position for the Fed. And finally, I think striking trade deals doesn't really mean the end of U.S. macro imbalances. The whole premise of imposing tariffs is to rebalance the trade book. But the U.S. chronic trade deficit is not because of U.S. imposing less tariffs than other countries. It's because the U.S. is a structurally undersafe economy in both the public and the private sector. And meddling around with the tariffs is not going to show those structural fundamental imbalances. So long as these structural issues remain in place, I'm afraid that tariffs is going to come back to haunt us on a periodic basis going forward. So overall, I think we are in a very volatile ceasefire, but this is not a credible end to the trade war.
How are equity markets then, particularly in the U.S., set up for August?
So how is it setting up for August? I mean, August the 1st is sort of gone and passed, and the market continue to sort of move higher. Obviously, it's corrected last Friday because of non-farm payrolls, but so far I think the market has been desensitized to tariff news. And, right now the attention is gradually shifting to macroeconomic data to gauge the state of the U.S. economy as well as where the Fed is headed in terms of rate cuts. So I think, unless we see big sort of news headlines about tariffs, for example, U.S. and China either striking a deal or negotiation fall apart, reciprocal tariffs make a comeback, I think market will continue to trade outside the tariff realms and focus on macroeconomic data in the near future.
Aidan, I think one of the points you're alluding to is this continued, perhaps U.S.-China rivalry. Aside from tariffs, what are some of the other ways that perhaps it might manifest, and how do you position for that?
So, I mean, trade is really front center. It's not just tariffs. In the trade front, on the U.S. side, it's a technology restriction. There's a ban on chips, although that we have seen a bit of a cooling of that tension. On the China side, it's a restriction on rare earths. And we have seen over the last couple of months that this restriction has, tangible power to bring the U.S. on the table and to substantially and credibly sort of de-escalate the bilateral trade tensions. Beyond that, there's a lot of geopolitics. You mentioned before our conversation that there could be, 100% secondary tariffs to punish China in buying Russian oil. So it's a delicate and very complex relationship, and it could move in either direction. If later in the year we get a meeting between Xi and Trump, then you could make a case that bilateral tensions may actually subside and the relationship could actually improve.
So how best do you position for this? I mean, we've been seeing that U.S. tech rebound in the past day for AI as a play, for example. Is there a preference perhaps for hyperscalers versus the infrastructure sort of weighs into the narrative?
I mean, AI is clearly still in the driving seat. If you look at the rebound since the Liberation Day, the Mac 7 is back in the leadership position once again, and is creating this very narrow rally that takes S&P and the Nasdaq back to record highs. And we are right now in the midst of the second quarter earnings season. Now, if you look at the overall headline number, you see that there's a pretty significant beat, right? Close to 80% of companies have a beat on earnings, and close to 75% is beat on sales. But if you dig a little bit deeper, you will see that the sales growth and earnings growth has slowed. And relating to our conversation, if you dig further deep down, you will see that the vast majority of that earnings actually contributed by technology sector. The overall, right now, the earnings growth in the second quarter is about 7.7%. But if you take out the technology sector, that growth rate dropped to about 1.9%. So it tells you that the vast majority of earnings is contributed by the technology sector, and that's very much the same as this very lopsided and concentrated rally in the U.S.
So what then do you make of this growing chorus of calls for a near-term correction, or even a medium-term correction in U.S. stocks? And I mean, juxtapose that with the other point you just made, that fine, it's narrow, but that's been enough, really, for the most part of the last how many years? So why should I be concerned about the negative breadth of this rally?
Sure. So for us, I think you really need to separate the short-term views from the medium to long-term views. In the short term, it's hard to fight against the market. Market momentum is very strong. Buying on dips, the mentality is very strong. Fridays is sort of a one-off, looks like a one-off correction. The market's rebound overnight. So in the near term, don't stand even the weight of the market when momentum is this strong. Over the medium term, I would say that there are reasons to be cautious about the U.S. assets. If you look at the equity side, it's discounting a very rosy outlook for the U.S. economy. Next 12 months, EPS growth is at 12-13%. No economic slowdown, let alone a recession. If you look at bond market, a break-even to saying that the inflation, the tariff impact is one-off, is going to trend back towards 2% in the coming quarters. So the equity markets are saying economy is no problem. The bond market is saying inflation is no problem. So it's discounting a very Goldilocks type of a scenario. But if I'm looking out a window, I see record policy uncertainties. I see a clear slowing global economy led by the U.S. and China, and I see very high geopolitical uncertainties as well. So what I'm seeing with my own eyes is very different from what's been discounted by the U.S. market, and that's why I think in the medium term there are reasons to be cautious.
Yeah, both equity and fixed income, to your
Absolutely.
point, consistent there. Right, we'll have more from Aidan Yao, who'll be joining us in a couple of minutes. Of course, we'll have lots more to talk about, including what the alternatives are, perhaps, to this U.S. equity market. Now, speaking of Tesla, it's a big story. China and its market there and sales there actually sliding back into declines as buyers opt for alternatives made by local competitors. We'll have the details coming up next. Counting down to the opening of trade here, Shanghai, Shenzhen, and here in Hong Kong. The opening bell just under 12 minutes away. And yes, that is the view outside, where a black rainstorm warning will remain in place until 11 a.m. local time. That's still within the next 2 hours or so. Plenty more ahead. This is the China Show. Welcome back. Going into the open today, under 10 minutes away, so A50 futures are down. We should have your pre-market pricing that should be coming up on your screen shortly as well. Global markets, Asian equities are extending the global rally. Still with us in Sept for some final thoughts on China specifically as well. Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. What I've observed in, at least within the Chinese markets narrative in the last few weeks or so, is the economy's doing well, but well enough that you don't need emergency stimulus, but not bad enough that you need, the other side. So in other words, it seems that this is not really a good spot for equity markets because you don't get either catalysts. Just your view on what this means short term.
So I don't think this is very much a policy or fundamental driven rally.
Okay.
If you look at the overall China equity complex, clearly the H shares perform so much better than Asia. Asia is very much a domestic driven, policy sensitive. H share nowadays is more technology. If you look at since the beginning of this year after DeepSeek to middle of the year, about 60% by our count of the MSCI China rally was actually driven by technology. And that's similar to the Max 7's contribution to the US rally in the last number of years. So to me, this is a very thematic AI-driven rally. And if you think that AI has a very long runway, have a very sort of a wide playing field, there's a fertile ground for opportunities, and Chinese technology companies are trading at much more reasonable valuations compared to Max 7, this to me is a secular trend that investors should pay attention to.
What about some of the structural shifts we're seeing, Aidan? I mean, massive investment in a dam, some of these other, plays. How is that? How is your view on that?
So I don't think it's going to significantly move the needle for the short-term economy. If you look at the dam estimate, it's about 1.2 trillion over the next 10 years. That equips to about 0.1% per year for GDP. We have also seen the child care subsidies, which could be worth about 100 billion a year. That's about 0.1% of economic growth. So in the near term, it's not going to move the needle, but these are the structural moves in the right direction. And I would say that these policies are, one stone killing two birds. It is much needed to sort of get the economy on a sustainable development, and at the same time, it does contribute to short-term economic growth. Even though a single project doesn't move the needle, but if you add more and more of these, then you could amount to a substantial size. So I think these projects are duly needed over the coming months if Beijing want to put a floor under this economy. And if you look at China's economic growth so far this year, the better than expected showing in the first half was really driven by two things: resilient export and policy front loading. Both of these engines are likely to splinter, right? Export is going to run into higher tariffs and slowing global demand. And I think the policy front loading is going to run its course in the coming months as well. So we desperately need more sort of stimulus to support this economy, to get the economy across the finishing line. So if we can get some of these projects that can both providing short-term growth impulse and structural reform, I think that's good for the economy.
Okay, Aidan will be rejoining us in a couple of minutes there very quickly. Amundi Investment Research Institute. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show, counting down to the open of markets here, 40 seconds away. Futures, A50 futures are on the softer side. Hang Seng is slightly to the upside, which is, I think, when you juxtapose that against the rest of the Asia-Pacific equity complex, underperforming today, not because of the weather, but the weather has been terribly depressing recently. So stay tuned for public service updates, of course, out of the government. The short version is here in Hong Kong, at least. The black rainstorm warning, Avril, will remain in place for about at least another 19 minutes or so. Avril.
Yeah, brace for bad weather, right? In terms of what we're seeing in markets, perhaps also brace for the US-China trade developments, still on the lookout for potential extension of that truce. And in the absence of that, as well as the Politburo stimulus front sort of disappointing, what investors are really focused on is earnings news. And we're seeing somehow mainland stocks managing gains at the open. It's worth noting that we also saw mainland investors selling Hong Kong stocks to the tune of about $2 billion. This was, I think, the most in 12 weeks just a day ago. But keeping that consumption theme going, you're looking at the likes of CATL or Guizhou Maotai, I should say, a bit firmer. Now let's take a look at how Hong Kong is faring as well. As you alluded to, likely to track what we're seeing in the rest of Asia, keeping tabs on some of these incremental developments on tech. Alibaba releasing an open source AI model. This is more for imagery. And along with that, we're seeing most of these Chinese tech names sitting negative. Baidu taking a bit higher. We had that tie-up with Lyft as part of its global expansion plans. And then on that EV theme, take a look at some of these Tesla suppliers. So we saw Tesla surging overnight, and this was after that $30 billion stock award, which cleared some of the overhang for Elon Musk. But also how Chinese shipments, that's continued to fall. So looking a bit mixed among its suppliers at the moment, David.
Yeah. I don't think there's anything there, really. The big news, to your point, though, was that massive $30 billion award out of Tesla. But that being said, underneath the hood, what does it look like, right? So you have some of the shipments from Tesla, the Shanghai factory specifically, slipping back into decline in July. That's amidst really this theme that we've been talking about consistently, intense competition there in the domestic market. Let's bring in Linda Liu, our transport reporter, who has more on this specific story for us. Linda, yeah, what have we observed here as far as this specific data point is concerned?
So Tesla's China shipments is an important indicator for the company, given that China, is the world's largest EV market. It's also Tesla's largest market outside of the US. So now coming into July, we've seen their monthly shipments from the Shanghai factory fall for 6 out of the 7 months that we have data for. So that's really concerning, for this company that's trying to get back on track sales-wise.
Linda, overall, where do you think Tesla can make a bit of headway in terms of a recovery?
Tesla is definitely trying to come up with new offerings in terms of technology as well as products to really try to get consumers interested in the company among all of these competitors in the China market. So Tesla managed to bring the advanced driver assistance systems that are called FSD, full self-driving, to the China market this year, hoping to compete with other rivals that are also very strong in this arena, such as Huawei-linked vehicles, as well as XPeng, some of the other EV companies. And you've got Tesla also developing a 6-seat Model Y SUV, really trying to capture the family-oriented market in China, which is a big segment for the SUV purchasers. But in terms of other new products, we've still yet to see a more affordable version of an EV coming from Tesla, something that Elon Musk has been promising but seems to be keeps getting delayed. Tesla seems to be really focused on its robotaxi operations now in the US, but that doesn't seem to be coming to China anytime soon. So I think in terms of coming up with new products for Tesla in the China market, it does seem to be fall a bit short.
Yeah, and to your point, this backdrop of really intense competition that Tesla has to grapple with on the mainland. Bloomberg Asia transport reporter Linda Liu for us there. And that's one of the key themes, right, David, that we've been watching as part of this anti-involution rally, and how some of these EV makers have been adjusting. Also watching some of the consumption themes out of the stock rally we've been seeing. Aidan mentioned this a short while ago. It's really driven by Tech, on the Hang Seng. On the mainland, we're watching some of these earnings as well, including from the likes of Yum China, Yantai, and the big one to watch, I think, 10 minutes from now, thereabouts. The China Services PMIs, a number to watch is 50.4. That would still be expansion, but represents a slowing from the prior reading. And of course, against the backdrop of the dollar moves, is becoming increasingly costly to defend the Hong Kong dollar peg. So a lot to unpack here, David.
Yeah, I think a third time in almost as many days, or second, at least this week, that the Hong Kong Monetary Authority has come out and defended the peg and on the weaker side of things, which is why I guess we're looking at HIBOR, of course, which is somewhat related to that in about 2 hours from then, whether or not that sort of adjusts slower given the liquidity issues here. I'm not talking about the weather, by the way, although that is also a liquidity concern here when you look outside your window. For some final thoughts, and maybe really on what this means for rate differentials, the big story this week globally has been, the Fed, it's a quiet news week when we're talking about the Fed these days. 100% probability is now priced in for the next meeting. Aidan Yao is here with us. Final thought here, Senior Investment Strategist for Asia at Amundi Investment Research Institute. 100% probability. I mean, there's nothing is 100% certain in life, right?
Yes.
What do I do with this number?
I think it makes sense to price in higher probability for September cut after Friday's non-farm payroll data. However, once again, I don't think it's as a done deal as currently been discounted by the market. And I think for two reasons. One is that we have to understand that the central banks, like the Fed, it's not its job to achieve a high absolute growth rate. It's its job to achieve a high growth rate relative to the capacity of the economy. And this is a particularly important discussion right now because the Trumponomics, Trump policies are actually impacting both the supply side and the demand side of the economy. Insofar as the labor market is concerned, tariffs are hurting demand for jobs, but at the same time, deportation, immigration policies are hurting supply side of the equation as well. So if you have the demand declines matched by the decline in supply, the overall balance of the labor market may not actually change. So the tightness of the labor market may not actually change. And this could be why, despite the lowest 3 months average of job creation, 35,000 from May to July, which is the lowest since the pandemic.
That's right.
Despite that, you actually have unemployment rate barely budging. It's only ticking up from 4.1 to 4.2%. And wage growth actually remains very robust at 3.9%. So even though the job creation from the payroll data was weak, but the data is not showing me significant slack in the labor market that requires the Fed to provide a rescue or policy action. So that's the reason number one. Number two, if you look at the other mandate of the Federal Reserve, which is inflation, inflation is moving higher sequentially, whether you look at the June CPI number or the PCE number. And it's across the board. Core prices, trim mean, median, ex-food and energy, core food prices is showing through some impacts of tariffs, and the core services is moving higher as well. So if the markets are correct that we're going to see further tariff pass-through raising inflation in the next couple of months, it could well be one-off. But what I'm saying is that Fed is going to get 2 more inflation print by September meeting. I don't think they're going to have enough information to assess credibly and confidently that this is a one-off shock or more persistent shock. So I think it makes sense to price a higher chance of a September cut, but this to me is not a done deal.
So beyond September, what are you paying attention to? I mean, to your point, we're not seeing, there are cracks in the jobs market, but perhaps not the kind of concern that warrants the market move that we saw on Friday. We also have, this data points and then Fed independence being sort of scrutinized. Is the assumption going forward just going to be more dovishness, markets getting ahead of themselves?
So I think there are two things that need to happen for the Fed to be confident about the easing policy. One is that inflation does appear to be, so tariff impact on inflation does appear to be one-off. If we get upcoming inflation numbers showing sequential declines of inflation, then I think that will give a lot of confidence to the Fed to start thinking about the easing policy in September. Second one is exactly what I mentioned, right? Slowing job creation is not going to cut it. What the Fed needs to see is the slack starting to emerge in the labor market, and that means that unemployment rate need to rise and the wage growth need to slow. If you get a combination of those two things, then that means that both mandate of the Federal Reserve are moving in the same direction. I think that will give the Fed the confidence to ease policy. And obviously, we have to think about the political pressure as well, with Trump, reportedly in days of nominating the governor into the federal committee.
Yeah, there we go. Optics is quite important too these days. Aidan, thank you so much. Aidan Yao there, Senior Investment Strategist for Asia at Amundi Investment Institute. About 10 minutes into the cash market session. Greater China up 51% on the Hang Seng Index. Look at Southeast Asia as we go into, of course, the thick of the session here. Inflation just came out of the Philippines 40 minutes back. The first time of sub 1% headline inflation in 6 years. Markets are running high. This is Bloomberg.
Quick look at China markets. We're seeing in the rest of the region the sort of bounce tracking Wall Street, and that follow through, I think, quite pronounced on Hong Kong and Chinese stocks. Of course, we are in the thick of China's earnings season, with Yum China set to report on Tuesday. So for an update on that and what else to watch out for, let's bring in our senior Asia equities reporter, Abhishek Vishnoi, for us. So, Abhi, what are you watching out for? I mean, in the absence of stimulus from the Politburo readout, in the absence of the continuation of the U.S.-China trade truce, investors are latching on to whatever they see from earnings.
That's right, and the earnings season has been a bit supportive. Like, I mean, the themes that you're seeing on the price action side, that's largely how earnings season has panned out. I mean, if you look at battery makers like Cattle, numbers have been good. But if you look at consumption oriented companies, Chow Tai Fook or some banks, numbers have not been that great. But in totality, I would say it looks like a glass half full. If you look at how investors have been behaving. HSI is, I think, just like 6% away from taking out a 2021 or 2022 peak, which can signal a further breakout. So that's good. And I think the quarterly GDP was 5.3% growth. That was good. But industrial profits had fallen. So there are certain themes which are doing good. Biotech, actually, by the way, did really well too. There are a bunch of companies which actually either came out with positive alerts or pre-earning announcements or reported better than expected numbers. So, the themes which are leading the market in terms of price action, like investors, building the price, they are actually delivering. But yeah, consumption, real estate, those earnings are still weak. So, but overall, it's a glass half full kind of situation.
What about for mainland stocks? I mean, we seem to be seeing this early innings of quite a solid rally. Investors, there's cash on the sidelines. Is this, potential unlocking of more to come that you're expecting?
There is still time for that. I mean, if you just plot HSI on one side and, CSI on the other side, you'll see how Hang Seng Index has done so much better and how CSI is sort of still stuck in a range. We were talking about 2021 highs when it came to Hang Seng. For CSI, I think we'll be talking about some multi-month high that needs to be taken out. So, that's the difference in picture. Even, in terms of flows and liquidity, HK oriented ETFs in mainland are seeing record amount of money coming in. Even mainlanders are way more excited about owning H shares. You're seeing, the exchange sort of diluting the rules a bit for more, listings in Hong Kong. So all in all, I mean, from liquidity as well as, from what we are seeing in terms of earnings estimates as well, Hong Kong looks much better. Mainland still has a long mile to walk. If you see the fundamental picture on the earnings side, I think CICC came out with a nice analysis that year on year, earnings have sort of in first half or first quarter have dropped, by several percentage points, and we reported on that. But if you look at HSI, just take out like the last couple of weeks, I think HSI was leading the earning upgrades in Asia, right? So these are very contrasting pictures.
Abby, thank you so much. Thank you so much. Abhishek Vishnoy there, our senior Asia equities reporter on really what's going on in the Chinese markets right now. Like the distinction between what's happening in the onshore and offshore markets. In fact, I'll use that as a segue because in the last 90 minutes or so, we've had two sets of PMI numbers coming through. One out of Hong Kong, still in contraction, but the highest since January. That's number one. Number two, you're seeing the market reaction of a stronger Chinese currency on the back of an extremely strong S&P Global Services PMI number for the mainland. 52.6 blows away every single estimate out there. That's coming in at the highest level in over a year or so. So these are sequential numbers, of course, to keep in mind just in terms of the data point and what it means as far as the improvement from the previous month, let alone, of course, the absolute value above 50. So this is a very good set of numbers coming through. And might this actually do more and give more reason, as Abby was just pointing out there, in terms of the data that's starting to form a more positive narrative? A very quick glance at technicals right now, given the rally we've been talking about here. MSCI China weekly chart, Fibonacci retracement from the peak in 2021 all the way back down. Green line is what you want to focus on, and we are bumping our heads on the next key juncture here. That next retracement level is we've been testing that for about a week and a half now, and we'll see whether or not we do manage to break above that yellow line. And we'll see, Avril, whether or not we do get something that powers this index above that key level.
Yeah, I mean, also to Avi's point, when it comes to earnings delivery, it hasn't been uniform, right? So the ones that have been leading market surge, they have been delivering, but there are some of these outliers. Speaking of which, the CEO of Hong Kong-based power generator CLP says the company is sticking to disciplined investment standards to drive long-term shareholder value. TK Chow spoke to us exclusively after first half net income fell 5.5% from a year ago on challenges in its Australian and mainland Chinese businesses.
This half year, I think CLP has demonstrated our resilience despite the volatile energy demand and also the heightened geopolitical environment. This is basically anchored by our core business in Hong Kong, but moderated by the challenges in the mainland business and also the Australian business. Now, in the mainland, we experienced less wind resources and also more kind of network restrictions and also tariff pressure. Now, in Australia, because of the more intense competition in the retail business, despite the fact that actually our generation business in Australia is performing good, our India business is continue to be stable, but there is a one-off impairments because of the transmission asset in India. Now, but our fundamental actually are strong. We have very good operational performance, high reliability in Hong Kong. We have also completed 300 megawatt renewable energy projects in China. We have also a strong pipeline in our markets. We have maintained an A-grade credit rating from S&P, and we will continue to uphold our disciplined investment criteria in order to generate long-term value to our shareholders.
It's interesting, TK, you say that this time around, in the most recent numbers, Hong Kong, that business actually anchored the upside, right? Does that mean the slowing demand picture that we saw earlier in the year is over? Are you seeing more input when it comes to demand from tourism as well as a pickup in the local economy?
Yeah, in Hong Kong, in the first half, we have about 1.7% decline in our demand. And actually, basically, it's because of a high base last year. Last year is a leap year and also exceptionally hot. So this year, we see the economy is increasing, is improving. And overall speaking, over the current 5-year development plan, we see demand to be about 1% increase per year. So, and also this year, we see very strong demand increase in data center business as well as EV charging. For data center, there was 6.7% increase in the consumption. And right now, data center consumption already amounts to more than 6% of our total consumption. But for the rest of the year, of course, it will depend on the economy.
What's your projection when it comes to coal prices going forward? Because prices have fallen to the lowest in many years.
Yes, for fuel prices, this year basically softened quite a bit. And we can see that the fuel cost charge in Hong Kong has dropped from 46.3 cents to 43 cents, so already a 2.3% reduction. So because we have a monthly fuel cost adjustment mechanism, so any changes in the fuel cost will be timely reflected in our tariff. But I think given the current very volatile environment, actually it's quite difficult to predict the ongoing price trends.
CLP Holdings CEO TK Chang speaking with our colleague Heidi Stroud-Watts. Plenty more ahead. This is Bloomberg.
Welcome back. About 25 minutes into the session here, and at least there's something that is on the brighter side of things. Well, for one, I picked a very light-colored suit today just because of how depressing and dark the weather is out there. I'm not sure if you guys noticed. My version of trying to help out sentiment today, but certainly not needed. As you can see, equity markets are on the front foot. Global equities put together the best one-day gain in 7 weeks on Monday. We're extending that, plus some data to note they're the highest services PMI out of China since May last year.
Welcome back to the China Show. Here's a look at the Hang Seng half hour into the session. We are seeing it erasing the earlier gain. So not quite tracking what we're seeing in Asia stocks or what was witnessed on Wall Street, that bounce that we saw. And I think perhaps also not helping is this bad weather that you're seeing over in Hong Kong, David. I mean, record rainstorm warnings in the city.
Yeah, it's the fourth black rain alert in a week. I think we have about an hour at least while this warning remains up. It's a good and bad thing, I think, for one, and people know about my rants about this, and it's coming now. So, number one, it's a bad thing because it's going to keep more people in the gym, and that means more gym selfies that we don't need on, taking up unnecessary space on global cloud. That's number one. So if you're at the gym, just do your sets. There's no need for a gym selfie. We don't need to see that. Well, yeah, so that's going to keep people in the gym. The good part, though, is we'll probably see less semi-popular influencers without, let's say, 5,000 followers posting, here's a day in the life of my life. Like, okay, no one really needs to see that, too. I don't need to see it, at least. Anyway, that's my rant for the day. But those two things offset, right? Because there's less people out the streets, there are more people in the gym. You're working from home, you have more time. Equity markets are a bit, as you can see, extending the best day for global equity markets in 6 weeks on MSCI. all-country index. S&P futures, as you can see, are catching a bid. We had a very strong showing in European cash markets yesterday. A couple of other markets that we've been tracking, of course, the big tech-heavy Taiwan and Korea are also catching a decently strong tailwind today. We're looking at, in terms of data, some things to tell you about. So the PMI numbers which came out, S&P Global China Services PMI coming in way stronger than expectations. And as you can see, dollar China is coming up on your screens, coming off lows of the day. But as you can see, that dip and reaction in terms of the renminbi strength and reaction to those numbers, quite visible on your screens. Do we have that on your screens? And what is that ticker? I just noticed that. Sorry, I need to get my eyes checked. That doesn't look like a market that I know. But anyway, it's up. Sometimes that's all that matters. As far as global equities go, of course. Okay, dollar China, there we go. Very strong number coming out, S&P Global. Number 2 is Philippine peso, very weak. And perhaps a good thing still in terms of the ability for the Banco Central to continue to lower interest rates. A sub 1% headline inflation number coming through this time in the last hour. More commentary coming through here out of the Banco Central. Risks from geopolitical tensions require closer monitoring. The reason why we're at 57.31 on dollar peso, we're coming off, I think, the best or the biggest single day drop on this specific exchange rate on Monday, going back to 2022. So it was quite a substantial drop there in this specific one. Apart from that, Avril, we're talking tariffs, and this time, of course, it's India, the U.S., and Russia. What's going on there?
Yeah, I mean, to your point, Banco Central looking for reasons to ease, right? And this inflation backdrop, I think, just feeds into the case for that. But we also have the RBI decision tomorrow. It's already been easing earlier in the year. But given these higher rates of tariffs that India is getting hit with from the U.S., I mean, what is that going to mean for the growth trajectory? And of course, amid all this discussion about central bank action, it's really about these bets on what the Fed is going to do next month.
Yeah, and I think right now it's about a 98% probability that's attached to a rate cut next month. And I think the interesting point that our previous guest, Aidan brought up was it does make sense that the probability of a cut goes up. It doesn't make sense that it's a done deal because we have a few more data points. And he thinks 1 or 2 more inflation prints, 1 more jobs report will not be enough, in his opinion, to cement a trend as far as the Fed goes. Now, whether or not it's enough currently already for an insurance cut, that's another thing altogether. But yeah, I mean, it's going to be an interesting topic, particularly, I think this time yesterday, Chris Weston joined us, right? And he said, after the next jobs report, don't be surprised if a 50 basis point cut debate begins. It's 76 right now. That's currently priced between now and the January 2026 meeting. So all things equal, that's 3 in the next 4 meetings that markets see a rate cut coming out of the Federal Reserve. It goes into the global markets rally, and as we talked about this trade war, no trade war, slowdown, what have you, global markets have continued this rally. In fact, I think on MSCI All Country already going into the first 8 months of this year, we're already, in fact, above our annual average as far as the annual gains are concerned. So it's been a decent year here, Avril.
Yeah, and, you know, as we've been discussing really about the Fed's trajectory, let's bring in Rachana Mehta, Regional Fixed Income Co-Head at Maybank Asset Management, for a discussion on this. So, Rachana, as David was just highlighting, we could see this debate about September being about 50, not just 25 basis points. What makes most sense for you?
Okay, for us, I think for me personally, I think it's 25 basis point rate cut. Actually, beginning of the year only, we are talking about 25 basis point. In September, we are talking about 2 to 3 rate cuts for this year. I think given that so far we have not seen the tariff inflation coming into the data, correct? Even for this month coming inflation data, which is in 1 to 2 weeks, I'm not even sure whether that the inflation numbers numbers will show the tariff impact. Maybe the tariff impact will start coming only after next, because there was so much of front loading of exports. So to me, I feel that I know a lot of people are talking about a stronger inflation number this coming for July. I think it may not be as strong as expected, and maybe that may give a green light because there's a big debate between employment and inflation, correct? So yes, we have seen a slowdown in the employment numbers, but the inflation, a lot of people are talking about the next 2 to 3 months is much going to be higher, given the tariff front loading of exports and no. So to me, I feel that maybe the tariff impact of inflation will come sometime starting from like August numbers for CPI. So this number may be still weak. So I do expect actually maybe because this is the first time, because I used to look at markets very differently, but I need to change my thinking, correct? Maybe what happened 30 years back is not going to impact now in terms of tariff, in terms of inflationary pressure, because a lot of restocking happened on inventories. So I do believe that there's a 99% chance that Fed should cut 25 basis point rate in September.
To your point about the jobs market,
yes.
How much weight have you been putting on the recent data? We know how non-farm payrolls are notoriously volatile.
Yes, absolutely. So for me, I think the July numbers is more important than the revision. So if you look at the July numbers, we're really, really weak. And if you go dig down deeper, a lot of the July numbers, the payroll, the private payrolls were coming from actually education, correct? Private education. So actually, if you look at it, the job market is really slowing. And given especially the service sector, and for me personally, that you will start seeing more weaker data going forward, because if you dig down the numbers, actually a lot of the private payrolls hiring were coming mostly from private education. So to me, I think that data is more important than the revision. And with stricter immigration controls, correct? So far, you have seen the unemployment benefits not going higher because the companies are not reporting. Maybe they will start reporting in next 2 to 3 months. So to me, I feel that definitely the labor market is going to slow, okay, for the next 2 to 3 months. Now, the inflation is a question, because there's a big debate between inflation because Fed has got a dual mandate. So to me, that is the most important thing. But I do believe that at some point, maybe the inflation is transitory, for at least for the short term. So that is what I think. Yes. Yeah, because the growth slowdown is happening. Because definitely growth slowdown is happening. Even Asian growth, that was very good in first half, but second half is definitely going to slow given the tariff impact. We have not seen the tariff impact on Asian economies yet. So I do believe there will be a growth slowdown even in Asia, correct, despite what is happening. Because so far the impact is going to start bigger. Like before it was 10%, now it's almost going to be 15 to 20%. So the average tariff rate by the US government will be almost around approximately 19%. So that, because there was so much of front loading to avoid the tariff, so I do believe that you'll see the growth slowdown.
I mean, you're alluding to some of this. When it comes to Asian economies, maybe some of the impact, we're not witnessing it just yet. Yeah. We just got the Philippines data. I mean, inflation, that looks pretty tepid.
Yes.
Bangko Sentral may be looking for a reason to ease, but do you think for Asia central banks, we just haven't seen the worst of it? Is that the same case?
Yes, I do believe that Asian central banks will cut rates more because the fiscal room is not there in a lot of Asian countries. So I believe that given the tariff impact and slowdown in the growth, and the currencies have been strong. I remember last time Asian central bank used to worry a lot about currency weakness, but I do believe that going forward they expect the currency to remain stable or at least stronger side, given that we have seen some dollar weakness given the policy in the US, correct? It's like people are moving away, they're hedging, especially a lot of pension funds, insurance companies have started hedging the dollar investment. I'm not saying the dollar investment they are going to sell, but at least they've started hedging. So I feel they have this cushion where they cut rates, generally the currency weakens, correct? But this time there's a dual pressure on currency because the hedging needs by a lot of pension funds, insurance companies. So I think central bank will go ahead and cut rates in Asia. So I do believe across most of the Asians, I expect rate cuts 25 to 50 basis points going forward.
Okay.
And Rachana, is the overall strategy then of these two things, steeper curves from here, curves have already steepened, just a note, and is the case finally strong enough right now to go higher, to go up in duration?
Yes, in fact, we've been talking about this duration for a long time. So the first half, we are taking duration in the local markets, especially Singapore and Malaysia, countries like that, because actually I thought the curve was very steep. And the second half, I do believe, especially August, September, this month, I believe it's good to take duration through U.S. Treasuries, especially on the credit space, like 10 and 30-year bonds. Like we've seen the 30-year U.S. Treasury holding about 5.1%. So I feel the new range will be 4.6 to 4.95 for the 30-year, and for the 10-year maybe 4.1 to 4.4, 4.5. So I remember that I was talking about the Singapore 30-year bonds has moved from 3% to 2.2. So I feel that it has done most of its rally. Now it will be in the range of 2 to 2.2. But yes, long term, I still believe the 30-year Singapore government bond may drop below 2. But for the short term, I believe it's good to move towards US duration, given that we also had Treasury refunding, and they said they're going to do more buyback in long end. So I definitely think that is good time to buy, because I do believe the steepening is happening, but it's bull steepening. So do prefer 10 and 30-year part of the U.S. government, at least for the next 1 month.
Okay, yeah, that's important to note, the bull steepening nuance. A quick question, though, on credit. So global high yield has done better than most parts of this bond market, fixed income market this year. Do you think that continues given where spreads are and given the macro outlook you've just outlined for us there of likely a weaker global economy moving forward?
Yeah, absolutely. In fact, global high yield has done very well. So we would prefer IG bond, investment grade bonds, and also we like GCC in the Middle East, like Gulf Cooperation Council. I think the spreads there for IG bonds are more attractive compared to Asia. So I do believe that Asian IG bonds will be moved in a range like 90, 80 to 100 basis point. But high yield bonds in Asia, I think still offers, in terms of absolute yield, I think it still gives you 7 to 8% yield, which is okay, correct? And I think Asian companies within the high yield space are still very strong enough to withstand the slowdown in the growth. But I don't trade US high yield, but I feel that yes, I do expect spreads to widen generally for the high yield, global high yield. But I think for Asian high yield, they will remain in a range bound. But definitely, I think we are tilting more towards investment grade bonds.
What about China government bonds?
Yes.
I think 2 year we're seeing something like 1.4, 1.5. Is that considered an attractive entry point for you?
I don't know, because China government bond, as of now, like last 3-4 months, I think it was very, very attractive, especially buying 10 and 30 year CGB. Not CGB, but corporate, because there were a lot of issuance out of CNH, and actually all these bonds did very, very well. But now I believe that I expect curve to steepen in China. So especially the 10-year bonds, I expect it to move another 10 to 20 basis points, and even a 30-year bond. So I do believe more I prefer US duration than local market, because local markets have moved a lot in terms of 10 and 30-year yield. So I prefer to take duration risk through US credits rather than local credits as of now. But if it moves 20, 30 basis points, then I would definitely like to pick up some of these bonds, yes.
Rachana, great to chat. Great to have you in the studio as well. Thanks so much. Rachana Mehta, co-head regional fixed income at Maybank Asset Management. Still ahead, President Trump ramps up his tariff threats against India, adding pressure on New Delhi to reconsider its Russian energy purchases. We'll have more details. This is Bloomberg.
Welcome back. Let's get you guys an update on the tariff and trade conversations. You might have waken up to this in the Asia Pacific. President Trump says the U.S. will be raising and really upping the rhetoric on India, tariffs on Indian exports over the country's purchases of Russian oil. Meanwhile, on the Swiss side of the conversation, the Swiss government says it is determined to win over the U.S. on trades, maybe a better deal. That's after President Trump slapped it, of course, with 39% tariffs. Right, on both these specific fronts, let's bring in our team here. Our Bloomberg government reporter, Sudhi Ranjan Sen, is with us to talk us through India. And our senior editor, Bill Ferry, is here to talk us through the latest as far as the Swiss go. Sudhi, let me start with you. And we've seen already quite a reaction coming out of India right now. How has, contextualize for us the comments coming through out of Delhi in response to Donald Trump's threats of penalties here?
Well, what we have seen is a very, very sharp rebuttal that has come from India, to the extent that India has gone ahead and said that, it's being targeted in an unjustified manner. And it has also pointed out and kept in the open as part of a statement the kind of trade that European Union and the United States itself does with Russia. It has again gone ahead and reiterated its old position that its energy purchases are directed by market forces, and that the interests of Indian consumers are primary. Therefore, one can say that from the past, from statements that we have seen in the past, which were largely conciliatory, which were not so sharp, there is a break, and India is kind of trying to say that it's had enough of being threatened or being threatened with tariffs and penalties, and that it will not kind of bend or kind of budge on this issue.
Okay, and what does this then mean for the... Sudhi, this is for you. What does this then mean for the broader relationship between the two? Is this actually a proper threat now?
Well, I mean, the broader relationship is quite deep, and if history is any indicator, over the past 2 decades, the relationship has only gone up. It's gone through troubles. It's gone through ups and downs. But on the overall, the trajectory has been an upward trajectory. So if that is an indication, then perhaps this is only a blip on the screen. But a lot will depend on how and what the United States and what President Trump does. Mind you, India holds the United States as a very key partner, and not only in the geopolitical sense, but also in the economic sense. It is looking out to the United States for investments, trying to get American companies, U.S. companies into India to start up manufacturing. At the same point of time, making common cause with the United States against China. So it's a very broad and a vast relationship. Whether the United States understands that, and this, there is an end to this back and forth statements coming from White House and India, that is not very clear right now.
Bill, just to bring you in here, but in a sort of separate but related conversation taking place, I mean, the Swiss have said they're prepared to win over the U.S. with a better deal. What does a better deal look like, though? What can they offer?
Well, anything lower than 39% would be a better deal for Switzerland at this point. Real shock over that decision by President Trump and his administration to impose that level of tariffs. A better deal, we've seen a lot of countries making promises of investments. There's not a lot of details on those promises, but something that perhaps would involve buying U.S. liquefied natural gas for import. Switzerland doesn't use a lot of gas for their energy needs, but they do use some. They could try to do something like that. They could make promises of investments in American manufacturing as well. We've seen countries like Japan doing that. So it's just not clear, really. I mean, with really about 48 hours to go Washington time before these tariffs kick in, it's not clear that there's time to do something before then. But perhaps the Swiss could also get some kind of a reprieve if the White House thinks that they're making a serious effort. So a delay in the implementation of Swiss tariffs. That's all very speculative at this point. The current reporting is that the 39% hits at just after midnight on Thursday morning, and the Swiss are going to do anything they can to try to stave that off.
Right. The context is important, though, because the trade relationship on the surface, when you look at it, Bill, is one of a surplus in favor of the Swiss. But, they pointed out that it's not because of unfair trade practices. What do we know about what type of stuff, Switzerland exports to the United States that have contributed to then that surplus?
Yeah, well, gold, at the top of the list you put gold. There's a lot of refining of gold done in Switzerland. That is affecting the overall trade balance. And then, we're talking about goods like pharmaceuticals. There's a lot of Swiss pharmaceutical companies. And, of course, on the luxury end, you're talking about watches. So, but it has been a $38 billion trade surplus that Switzerland has with the U.S. That's not top 10, but it is top 20 among nations in the world. And we know know from even President Trump's first term, he looks very closely at those numbers specifically, and it doesn't really matter to him typically what constitutes that trade surplus with the U.S. He just wants that number to be smaller.
Okay, well, this is probably a way to do that. Bill, thank you so much. Bill Ferry is our senior editor in Singapore for us, and Sudhi Ranjan Sen, of course, on the Indian side of things. It's also worth pointing out, though, of course, as we have these conversations, when you look at oil and you look at Nifty futures, don't seem to be extremely perturbed by the latest rhetoric coming through there. Right, about an hour into the cash market session, and equity markets are just bobbing between gains and losses here on the Hang Seng Index specifically. We'll get you an update on the weather next. CSI 300, I believe, is now at session highs given where we are as far as that goes. Asia is better by 0.5% this Tuesday. This is the China Show. Welcome back. In some corporate headlines we're tracking this morning, Bloomberg has been told that the Adani Group is exploring a tie-up with China's BYD. That's to make batteries and extend its push into clean energy. Now, sources say the conglomerate's chairman, Gautam Adani, is personally leading the discussions with the group aiming to begin mass production of lithium-ion cells. Now, in a stock exchange filing, the Adani Group denies it is in talks with BYD. Now, we're looking at shares of Baidu this morning, coming up on your screens very shortly. At a big pop overnight. We're not really doing a lot here in Hong Kong. This partnership with Lyft, rolling out robo-taxis in Europe by next year. The service would start in Germany and then in the UK and follows Lyft's acquisition of the taxi app Free Now that operates in 9 countries. Now, the companies say the fleet is expected to grow to thousands of vehicles across Europe in the coming years. Right, before we go, we'll just look at banks right now. We'll talk about other stuff on the other side of this break. But yeah, there's a note coming throughout of Morgan Stanley, and they've raised effectively the price targets here for some of the names you see on your screens. That's on anti-involution funding curbs as it pertains to the financial sector. We're looking at gains there. And yeah, I'll talk about this later. I don't have time for this. But yes, we'll talk about Meituan next. Welcome back to shows. We're going into the Tokyo lunch break right now. Nikkei, topics, and BOJ minutes, of course, very much in focus right now. Today, specifically, in terms of the other things that have been tracked on the macro front, we've had a series of inflation numbers in the Asia-Pacific. You had South Korea coming in that was in line with expectations, and then the Philippines coming in below expectations. I guess it goes into this conundrum of the tariff uncertainty, but the data is, at least in most parts of the region, fairly clear and consistent with, I guess, a more favorable rate environment, favorable meaning on the lower side of things, with the exception of Japan, of course, which is dealing with the same dynamic of uncertainty, but that's holding back perhaps these bets of higher rates over in Japan. But as you can see, as far as the 10-year yield goes, it's certainly a boat that's now left the dock. Okay, Asian markets are looking like this, 0.5%. S&P futures are coming off a little bit highs of the day. The dollar was slightly on the weaker side of the cutoff, at least the Bloomberg gauge. That's really an amalgamation of other moves across the Asia FX space. Most sectors are trading on the way up, and I think more favorably when you look at risk from a risk appetite perspective, it's cyclicals and sort of high duration pockets of the equity market that are leading these gains that you see on your screens. Right. Apart from this, other data that's come through today, PMI numbers out of Hong Kong. So up, I think the highest here in Hong Kong going back to January of this year. Still in contraction, though, but that's encouraging. That's number one. Number two is the big surprise actually came in the form of the S&P Global China Services PMI, which effectively came in a couple of points ahead of even the most bullish forecast there. So that's really leading to the strength in the Chinese currency, in what's really, by the way, a fairly quiet day as far as the news flow goes. But yeah, anyway, the day is young, as we say. Okay, let's focus in now on China. So President Xi's chief of staff has met with experts in the seaside city of Beidahe over the past weekend. That's according to state media reports. Now, that's a sign that the country's top leaders have begun their annual summer retreats. Min Lo, our China correspondent, is here with us to talk us. So let's start things off with for those that are unfamiliar, the significance of the Beidahe annual meetings.
Yeah, so every year around August, the top party leaders will disappear for a couple of weeks. They would travel to the seaside town of Beidahe, about 300 kilometers away from Beijing. Ostensibly, it is a time for them to take a break from the pressures of Beijing, but in the past, this has also been where key political decisions have been made. You can think of the two sessions as where, formal decisions are made, legislation is being passed by the rubber stamp parliament, but Beidahe, some say, is where the real decisions are being made, and usually it's shrouded in secrecy, and this is possibly the closest that we would get to a confirmation from state media saying that Cai Qi, the chief of staff of presidency, is meeting with experts, which is quite routine. They would often invite experts. This time they come from the field of tech, social sciences, and basic research. Not a lot of details. The theme is contributing to a new era, but that's all we got for now.
Okay, and typically, what happens?
So this is a time when party elders, retired party leaders would be able to participate in decision-making, where there would be a lot of jostling for power among the different factions. There would be sometimes fierce debates, not just on the policy front, but on political decisions like succession planning, who's going to move up the ranks of the political party. In the past, if you think about it, Mao Zedong, who started this in the 1950s, he had decided to launch the Great Leap Forward during the Beidahe meeting. He decided to shell Kinmen Islands during that fight with the Kuomintang party during the Beidahe meeting as well. But in recent years, it had taken on less significance than before.
So, yeah, okay, so I guess that's to the point that you just made there. So for this specific year, what are party leaders expected to have discussed?
Yeah, well, it's taken on less significance. This year, again, we don't really get a lot of details from state media, but you can imagine that the leaders will discuss what is most present and most urgent for the party leaders to talk about, and that would be, I guess, the economy. This is coming just ahead of the party plenum, where they would discuss the 5-year plan. So they would discuss, things like how to expand domestic consumption, some of the issues related to geopolitics, its relations with Russia, given the military parade coming up. But in recent years, because presidency has pretty much consolidated his power, some say that he has shifted away from this era of backroom politics to a more formalized sort of rules-based governance, which some analysts say is going to be critical for the longevity of the Communist Party for the next 100 years, given that this new crop of younger leaders don't share the sort of political background that the founders did, like, Mao Zedong, Deng Xiaoping, where they fought alongside each other for many years, and they don't have that sort of shared background. And so the more formalized sort of decision-making process could be more important for the longer-term survival of the party.
Min, thank you so much. Min Lo there, our China correspondent here. Okay, let's just very briefly turn to, in other news this morning, let's talk about this. So Beijing, and the weather's quite significant, of course, as far as the mind space today is concerned. And yet we continue to track the fairly strong rains that we're seeing in Beijing. A round of torrential rain just a week really after downpours unleashed flooding that killed at least 44 people. Now, the city's weather service raised its rainstorm warning to red. That's on Monday, with the heaviest rainfall expected through dawn on Tuesday. In Hong Kong, we're operating under a black rainstorm warning, which up until a few minutes ago would have been hoisted up until 11 a.m. We're now getting an update there that the black rain alert will remain at least in force until 3 p.m. today. So that's an extension of what we understand so far. That's really what Hong Kong looks like from our windows here in central Hong Kong. That's a look at the peak, if you can even glean anything from this sort of live shot that we're seeing right now. Effectively, what it means operationally is that the government has shut schools for days, and courts have been adjourned until at least 3 p.m. But of course, markets continue to trade here in the city. Now, Australian federal police have charged a Chinese national under foreign interference laws for allegedly collecting information on a Buddhist organization targeted by Beijing. Now, the woman is also an Australian permanent resident, and police say that they expect more arrests. Now, Australia introduced foreign interference laws back in 2018, and the case actually raises the risk of renewing tensions between Canberra and Beijing. Now, let's stay in Australia and the plan there to ban children under 16 from social media. You might have heard and read about this. And as you would imagine, it sparked intense debates with Alphabet's YouTube at the very center of things. Catherine Thorbeck, our Bloomberg Opinion columnist, says protecting children from online harm won't be as simple as it sounds, and she joins us from our Tokyo studios right now. Catherine, good morning, and just take us through the thinking here, and why do you say that banning teens from YouTube won't actually keep them safe?
Right. Good morning, David. So I think this is really taking a simplistic solution that sounds very appealing to parents and caretakers who might be, exhausted, but it's using it to try to solve a very complex problem. And research from the American Psychological Association actually says that these hardline age limits are not effective at protecting young people from online harms. They are sort of a Band-Aid solution, and they don't address the root causes of these risks. So they might keep some 15-year-olds offline, but then they leave those same teens vulnerable as soon as they turn 16 to some of these threats. And I also think, I think we're being a little bit naive if we say that young people who really grew up on the internet and are very tech savvy won't find ways around these sort of age limits. And we've already seen that play out in other jurisdictions that have implemented these sort of age limits. And so I don't see how this will actually end up keeping any teens safe.
Okay, so that's the nuance between 15 and 16, and of course their familiarity with being able to get around it anyway, if that is where we're headed. My next question is specifically, why on YouTube? And how is the conversation different over YouTube compared to other social media platforms?
Right. So I think YouTube's especially interesting, and not just because of some of the drama we saw in Australia about the promised exemption that was then reversed. I think YouTube is also unique because some data from the U.S. shows that YouTube is actually the most watched television streaming service of all. It's beating out some of these juggernauts like the Walt Disney Company and Netflix, and it's really just so closely tied to youth culture and pop culture, especially in Australia. And when I think of YouTube in Australia, I think of Troye Sivan, the Grammy-nominated singer who really launched his career on there by posting sort of pop cover songs and vlogs as a teen. So I think it's a really important outlet for young people. And at the same time, YouTube is an interesting case because they've also shown that it's possible to launch products that are specifically geared towards young people and aimed at keeping them safe. YouTube Kids was launched because most parents and people sort of recognize that it would be unwise to sort of just turn a blind eye and assume that these kids won't be on YouTube, and that there isn't a lot of educational material and Miss Rachel and Sesame Street and stuff like that kids do want to access, but there do need to be safeguards in place. So YouTube has sort of shown that it is possible to sort of clean it up and make it safer for young people without just banning them outright.
Okay, and in terms of this being, principle and actionable concrete thing that lawmakers and parents can then endeavor, what can they do to actually protect young people from online harm?
So I think one thing that Australia does get right here is that the onus really does have to be on these tech companies to clean up the internet for young people. The UN Children's Agency says that access to the internet and access to outlets for freedom of expression is actually a right of children. But it really is on these lawmakers and especially on these big tech companies to make sure it's safe for them to access that. So I think they really need to keep the pressure on these tech companies. One way to start would be to asking them to open up their algorithms to outside researchers so we can really see what the actual harms are and come up with sort of targeted solutions. But I think, pretending that kids won't access YouTube is easy, but the governing is harder.
Yes, there we go. And I think that's a more complicated matter, of course, to try and endeavor. Catherine Thorbeck, thank you so much in Tokyo, our Bloomberg Opinion column. As you can check out, by the way, her column there for our Bloomberg clients. Okay, just going into the very short break right now. We'll leave you to look at markets, Hang Seng, CSI 300, what's going on in Singapore, and also on the Kospi Index. And again, to, I guess, a spectrum of a market that's trading sideways to one that's actually doing well, although coming off highs of the day on the Kospi Index, 1.2% there over in Seoul. Welcome back. The CEO of Japan's biggest bank, Mitsubishi UFJ Financial Group, says it is desirable that the Bank of Japan raises interest rates as soon as its next meeting in September, given the higher inflation outlook in the country. Hironori Kamezawa spoke to Bloomberg exclusively about interest rates and Japan's recent trade deal with President Trump.
I don't think everything is completely clear yet, but the fact that an agreement has been reached is significant. I believe this gives us a clearer outlook than before. An increase to a 15% tariff is not a small number, and many sectors and companies are likely to be affected. On the other hand, the fact that we can now see some clarity is important. When we set our performance targets at the beginning of the fiscal year, we did so based on the assumption of an increase of tariffs to 10% plus a buffer, the level at which the global network and supply chain would not be disrupted. In that sense, the 15% increase is slightly higher than our initial forecast, which was closer to 10%, but it's still within the range we expected. Overall, regarding the outlook for the Japanese economy, I think the underlying economic recovery will remain intact. GDP will probably decline by around 0.5 to 0.6%, but the underlying economic recovery will continue. As for our current plans at MUFG, we believe that there is no need to make any major changes at this point. There are a few uncertainties, so we'll wait until the situation becomes clearer.
JGB yields are rising, not only for ultra-long-term bonds, but also for 10-year bonds. You've explained that you are taking a cautious approach to position building. Could you explain that? In addition, how high do you think 10-year bond yields will rise in the future?
We do not consider it prudent to publicly disclose our position at this stage. But our basic view is that given the current trend of rising interest rates in Japan, the key question is at what level we should purchase bonds. At the same time, as seen in the results of the recent upper house election, rising yields are an alarm bell in the policy debate over fiscal expansion. I think the trend will continue for a while, so I don't think it's a situation where we should rush to buy right now. While it's hard to pinpoint an exact level, if we assume a terminal rate of around 1.5%, the 10-year yield at that point would be around 2%. So the range from the latter half of 1% to around 2% could be a level where we could consider buying. But as I mentioned earlier, the current trend is toward a slight rise in interest rates. So I think it is important to watch the situation closely and wait for the right timing.
The Bank of Japan held its monetary policy meeting. The decision was to keep rates unchanged, but with tariff negotiations settling down, some are saying that the environment for a rate hike within the year is in place. What is your view on the possibility of a rate hike within the year?
Our official company view sees March next year as a possible timing of the rate hike. But personally, I think September or October is quite possible. I think that a rate hike in September or October could be desirable. The reason is that inflation is still quite strong. The number of items subject to price increases has grown by about 5 times compared with last year. And there is also the issue of imported inflation. In that sense, I personally think that this autumn is a reasonable time for an interest rate hike. But as various statistical data will be released in the coming months, if the growth rate figures are not as strong as expected when they come out, there may be discussions to take a wait-and-see approach. The timing could shift to around March next year. We'll see a period of careful monitoring of economic data, but I think it's entirely possible.
Exclusive conversation there with the CEO of Mitsubishi UFJ Financial Group there, of course, with our colleague Hideki Suzuki there. In fact, just on that note, they were touching on how high can a 10-year JGB yield get. The BOJ minutes just released this morning does suggest that many board members have just effectively held the view that the central bank, if the central bank pulls back too quickly, from being buyers of JGBs, it might have unforeseen consequences in terms of market stability. One to watch today, of course, on the back of those minutes, inflation numbers coming through out of the Philippines and South Korea. Perhaps more newsworthy is the softer prints out of the Philippines coming in at 0.9%. And in the Hong Kong markets, well, two things are coming together here. It's obviously just a Fed conversation around rate cuts being on the horizon. We're testing, as you can see, again, the weaker end of the trading band. The HKMA has had to act several times already. Very recently, we'll get HIBOR in the next hour coming through as well. And we have PMI numbers, which came out about 2 hours back, which Goldman Sachs has a very interesting note about. And we'll tell you about that note in a couple of minutes. Plenty more ahead. This is the China Show. Welcome back. So we talked about banks early on with that Morgan Stanley upgrade on the price targets. That's an anti-involution reasoning behind that call. Separately, but also in financials here is, as you can see, we're looking at gains across some of the brokerages on the back of this report that's come through about China looking to strengthen some oversights over some stock gains overseas. For the specifics of the report, we know so far, we've talked about this as well previously. Trista Law is with us, our China credit reporter, joining us now. Yeah, what is this about? What do we know specifically about this, Trista?
Yeah, so it's actually the first time Chinese official media to report it on this role. We have been following on this for quite some time. China has strengthened its oversight of citizens' overseas stock trading gains. We firstly reported this rule change last October, and then we have another follow-up earlier this year mentioning like China extended its scrutiny on those overseas investment gain to actually less wealthy people nowadays compared with last October. We reported that they're actually targeting those wealthy people. So overall, I think it's a very clear signals that China has strengthened its effort on collecting more taxes on this kind of investment gains.
Trista, thank you so much, for clarifying that for us. We've reported on this, as she was just pointing out there, because first time we're hearing it, of course, from state media. Okay, other parts of the market we're tracking, so that covers the brokerages today as far as the cash markets go. We're looking at banks as well coming up on your screen shortly. So your big four from ICBC all the way down to about Agbank. That is not, of course, in order of size or scale. That's the big four on your screens. Morgan Stanley's out with a note here. Raising their price target on the banking stocks on the back of these anti-involution funding, saying that the new funding controls to the sectors that are overcapacity will support their prices. That's a note there out of the analyst team at Morgan Stanley. Right, flip the page and let's have a look at Citi's note. This is on Meituan and the profit there. Under pressure in 4Q amid competition. Let me just read that out a little bit further. While the food delivery competition may reach its peak in the third quarter, which we are currently in, following, well, for one, the regulatory warning coming out of officials, and number two, of course, the players themselves have come out and said they are going to do their part. Citi remains cautious on the instant retail segment in China. There is a limited chance for Meituan to scale back its overseas expansion. The price target is cut there to 188 from 192. As it pertains to other things that we're tracking here, we did get the PMI numbers coming out of Hong Kong, along with other PMIs here. And Goldman Sachs came out with a little bit of context here as far as the S&P Global Hong Kong gauge is concerned. So an improvement from June, 47.8. We've gone up to about 49.2, which effectively takes you back, I think, to the highest level since the start of this year, January or Feb. It might indicate underneath the hood, that might not tell you the whole story. Inflationary pressure on the downstream sectors has increased somewhat in July. By the way, not to mention, and I'll use this as a jumping off point to remind you of the weather, where the last several weeks have seen really extreme weather scenarios here in the city, which has really, well, it hasn't shut down the actual market itself. It certainly kept people off the streets, which is, I think, it's something to consider when you look at what retail sales will look like for July, what the PMIs will look like then for August. And again, public service reminder that in the last few minutes or so, we've gotten an extension from weather officials of the black rain alert here will extend to at least, or will remain in force until 3 p.m. today. So if you don't have to make it into work, you can work from home, do so. Keep safe, keep dry, of course, is the number one priority there. We're looking at Hong Kong markets at 10 to 1% to the downside here. In the first 90 minutes of trade, 24/7 right now is where we are here on the Hang Seng Index. It's worth pointing out just two things before I go. The HIBOR is coming out in the next hour. We did dip back below 1% this week. Does that continue given the intervention? And again, the liquidity in abundance, not just in the weather, but also in markets right now. We will see you all tomorrow. Thank you for joining us today.